All right, let's move on to technology, because big tech, a big part of this record rally, but I mean, what's new? And stocks go up because people want to buy them more than they want to sell them. And that has really been true lately. Listen to this new data from Bank of America showing 9 straight weeks of inflows into technology. And Shannon Saccoci, I want to read you another stat pulled out by the hardworking halftime team. This one just is bonkers. Every 60 minutes in the markets, global technology stocks increase $780 million in value. $780 million in value every 60 minutes globally going back a few years. That's just nuts.
Yeah, I mean, it doesn't surprise me. One of the things we've been talking about over the last few years is every quote unquote dip has been an opportunity. And I think what's happened over the last few months is that the relative underperformance of these stocks has provided an opportunity, and we're seeing that. What we're also looking at is thinking about where the spending is going to be over the next few years. And whether it's 2% or 2.5%, GDP growth over the next 2 to 3 years, that's still sort of a low growth environment if we look back historically. But enterprise spend is really picking up. We think about 2020 and companies were basically stalled out. They had some projects that were in flight, but they weren't putting anything back into enterprise spend. We're also seeing small and middle-sized businesses get into enterprise spend as well. And so if you think about how that could potentially impact some of these big cap tech companies, and it's not just Microsoft, it's IBM and Cisco, which we own in our portfolio. I think you should be excited about this potential next 2 or 3 years and not lose sight of the fact that these companies have delivered excellent earnings and execution along with strong balance sheets and incredible free cash flow throughout 2018, 19, and even in 2020.
Jason, I know you've talked on this program about Nvidia, about Qualcomm, some of the chip stocks, Amazon, particularly like an Nvidia. Okay, all-time record highs. Again, one of the best performing stocks in the world. Are you trimming these at all? I mean, at some point you say, okay, we made a bunch of money. We got to take some profit.
Yeah, it's a great question, Sully. I'll say this in respect to Nvidia. It's the gift that just keeps giving. And, obviously the semis can be a very cyclical oriented aspect of the market. But Nvidia, I believe, is just the gold standard. They're in everything, from gaming, from machine learning, from AI. So it's hard to trim these names because they just keep on running. But Nvidia is just a great pick. And then in just respect to technology as a whole, I think technology has played different roles, over the last decade. Obviously, it's primarily growth, but it has leaned more defensive, over the last several months as investors start to take into some volatility and say, well, growth at a reasonable price is maybe FANG is where I could find it.
Is it still a reasonable price on Nvidia? Are you still holding on to that gift?
So it's not clearly. Obviously, it's an expensive stock, but I think it's expensive for a reason. They are the gold standard in this space. It's worth owning. And quite honestly, if there's pullback, I think that's a name that's worth buying on pullback. So Nvidia is a great one here.
If we ever get a pullback in the next 25 years, who knows? All right, let's move on now and talk about some of the cyclical trades, particularly the financials. They have also been hot. In fact, many of the financials are at or near record highs. And the group is actually the top performing sector this month and this year. Jim, I know you own Goldman Sachs, you own Citi, you own Berkshire Hathaway, which is kind of a semi-financial / insurance company. Are you, kind of like Jason with the semiconductors, are you still hanging on? These have been the gifts that have also been giving.
They've got a lot more to give, Sully. That's my opinion. I've been saying this about 2 months now that everybody's saying it's interest rates. I think you're missing the picture. Sure, interest rates matter. But what matters more is that we're early in an economic expansion. And I have to stress that. This is the point where loan loss reserves go down. This is the point where loan balances go up. This is the point where shares are bought back, in the case of Citigroup, below tangible book value. In the case of Goldman Sachs, around book value. Similarly for Berkshire Hathaway. So you've just got all these positive forces going. And, oh, by the way, I think interest rates are going to keep climbing and the yield curve steepens. So I think we're still very early in this financials trade. This is part of the global picture for value and cyclicals, whatever you want to call it. You're early in an economic expansion. This is when value stocks are supposed to work, and they are.